Okay, this is Chuck, Low Trade, and I'm going to start a chart on Barclays. What we have here, I've already pre-drawn the pattern, which I've noticed. And as you can see, we're looking at a double bottom here. Now, a student of mine requested this because he felt that there was a rising wedge here. He felt that coming from this point, working your way up gradually, and then from this point working your way up, that a wedge formed. Well, a wedge did form, but it's so sloppy I had to just disregard it. I'm sorry. What I did notice, though, is a sloppy double bottom. As you can see, this bottom point is higher than this bottom point. Now, I go by a rule of as long as the two bottom points are within 5% of each other, you can use it. And this one just happens to be on the borderline. I did the calculations over here, and you can see the lowest point here, plus 5% goes to 1710, and we're right now just about 1715 or 1725. I'm going to allow it. So what we have here is a sloppy bottom, double bottom, I'm sorry. When you do a double bottom, you always go over to the left to draw your top line and start at the reversal. And you work down to the peak of your center, and then the line extends down. Now, normally you try and find these before this breakout, so I'd say you try and find it back around this area, and then when it breaks out, that's your entry point. Now, if you go up, if you look right below here, we have an overlay of the 5, 10, and 20 moving averages. I use those as a entry signal. Whenever they're lined up in order with the 5 on top, the 10, and then the 20 below, that means that you should be in the stock. Anytime there's a cross, that means that you have an entry opportunity. Now, if you look all the way down here, you're going to see where the original entry opportunity was forecast. The 5 crosses the 10, that would be an early entry, and when the 10 crosses the 20, that would be a confirmed entry. So right at this point would have been the time that you should have entered. Now, coming up here, you saw that I mentioned earlier I would have tried to enter at this point. But at any rate, you see it tapered off here and bounced off the 10 again and then broke away. So again, right at the breakaway point where you're breaking out across the top trend line, you're getting an entry signal, a confirmed entry signal with this overlay. Now, if we go up above, the other indicator that I love using for entries is the DMI. You go up above and you'll see the green one is the positive and the red one is the negative, and the ADX, which is the average of both, is the black one. Now, up here, when you see the green one actually cross above, that means it should start into a run. And to confirm that run, you need the black line to turn and go in the same direction as the upper line. So if you're looking at this, right about here, you can see that's when this started trending up. So right about here would be the confirmed entry, and the cross would be the early entry. Just like down here, you could have an early entry when the 5 crosses the 10, and you could have a confirmed entry when the 10 crosses the 20. Up here, you have an early entry when the green one crosses up, and a confirmed entry when the black turns and tones up with it. So this, if you look at this point coming down here says to enter here. Early entry says to enter right at the breakout, and down here, if you look at it, you're seeing enter at the breakout and so forth, but your early entry is way back here. So you have 2 entry signals giving you indication that you should be in this trade. We're going to come all the way down the bottom, and we're going to look at the other supporting indicators. I use the Scotch RSI, and the black lines that fluctuate between 0. Anytime that you're above the 80 line, up in here in the green, you should be in the stock. Anytime you're below the 20 line, which is like down here in the red areas, you should be out of the stock. Now, some people play the RSI anytime there's a cross of the 50, either up or down. You'll either enter or exit. I would never do that. It's just has too much whipsaw involved, and you're going to end up jumping in and out of stocks all the time. So I only use this as a supporting indicator, which will support my entry signals above. If I had an entry signal above and it was fluxing around here, I would say I had very weak support for that entry signal. But as you can see, the entry signal started down here, you had it, and then the entry signal started here and you had it. Be in, be in. So you're supporting that entry signal. Now down below we have the CMF. Okay, the CMF is a pressure. It's a indicator for money flow, and what I use it for is to see whether there's positive or negative pressure on the move that's taking place. The CMF normally, you'd say anything above 0.25 is strong pressure. So up here you're seeing strong pressure, as you saw this move happen. But down here, your pressure really is, you got pressure, you got positive pressure, but it's not strong. That's probably why you saw this peter out here, and instead of continuing up all the way, it came down. You just didn't have the pressure behind the move. Now the last thing I want to talk about is volume. And this comes into the area of the wedge that my friend was talking about. One of the indicators on a wedge is that at the end of the wedge, normally the upper line would not be reached. The upper trend line would not be reached. So right about here, when this started tapering off like this, that would mean that you're meeting the last bump up, and it should come over to the bottom trend line and then on reduced volume. So you would have reduced volume here, and then it would break through the bottom, and then you start your decline. The problem with this, this also supports it not being a wedge, an upper rising wedge, because of the fact that you had that indication that you reached the top peak and you traveled sideways to the bottom peak like you're supposed to have, but there was no breakout on falling volume. So that's the second reason that I would say this is a sloppy upper rising wedge, but it's a failed one because the volume came at about this point, and at that point, because it declined to that point, this wedge should have broken out south on declining volume, and it didn't. It increased. The last thing I'm going to mumble about, seeing as this isn't scripted, is that when you calculate your double bottom target, you take your line where it crosses the peak and you draw a straight line down to the bottom line. Then you take that figure, which is 17, and you subtract it from the high figure, which is 21. So you're seeing you got 21 minus 17, it's 4. So then you go to the breakout point where it breaks out, which is 20, and you add that to that, and then you'll find your target, which is 24. So that's just this is the first time I've tried this, and I'm mumbling along. I really should have scripted this, but I just wanted to do this quick because I had an opportunity. That's about it for now.